just meant that we were supposed to be together. And I knew it. And I knew it the very first time I touched her. It's like coming home, only to know home I'll never know. I was just taking her hand to help her out of the car, and I knew it. It was like magic.
Good morning, everybody, and welcome to our latest edition of Cartesian Talks. My name is Carl Nalter, and it's a great privilege to be the facilitator this morning, but don't worry, you're going to be largely hearing from Anthea, and my job is really just to facilitate and make sure we get your questions to Anthea. As always, Anthea's job is to help us get rich, either for ourselves or for our clients, and I'm really delighted to see that we've got joining us this morning, retail investors like teenager Heno, right through to clever retirees like Derry Christian, and a whole mixed bag in between, Anthea. So good luck for making sure you give us all fabulous content, which I've no doubt Anthea will do. A reminder, please ask your questions in our Q&A section. Anthea is very keen to get through as many of those questions as possible. This webinar is available afterwards, and you'll be sent the link so that you can access it and share it with your colleagues, friends, and clients. And we're also streaming it on the CN&CO YouTube channel to make sure that we get as many people as possible enjoying the benefit of Anthea's wisdom. So without any further ado, we're going to kick off with a short presentation by Anthea to set the scene, as she does so well, and then we'll take your questions. So Anthea, on a freezing cold Joburg day, warm our hearts by making us rich. Please, over to you.
Thank you, Carl. Good morning. Yes, it's not warm out there, huh? Thanks very much. So, you know, the traditional, what's become the traditional Zoom, I'm just going to share my screen comment with you. Let me see why it's not doing that. Okay, here we go. Please tell me you can see that.
We can indeed.
Oh, there we go. Now I can also see it, see what I'm doing. So this morning we're talking about investing in yielding assets. And I want to start with the basics. You know, there's a couple of types of yielding assets, bonds, property investments, to name the two major ones. And today I'm going to focus mostly on bonds and the fixed income market. Property really deserves a webinar of its own almost. So let me get started. In short, a bond is a debt instrument issued by a company or government. The borrower, the investor, that's us, the lender, purchases the bond or the debt and gets paid interest, which we call the coupon, which can be fixed or vary with interest rates, right? The issuer of the bond, which is the company or the government, is expected to repay the capital borrowed at the end of the bond term. Now, I mean, that's just dreadful, quite frankly. But in short, when we as investors buy bonds, we're lending our money to the company or the government for a fixed term. So to make it easy, let's say for 5 years, then for the next 5 years, they will pay us interest. Mostly it's accumulated and paid every 6 months or so. I mean, these things vary, of course. And at the end of the 5 years, the government or the company repays to us the full amount that they borrowed from us originally. So just a quick aside, most people don't even realize it, but if you have cash in the bank, you're the lender to the bank. You're lending the bank your money. They pay you an interest on the money they've borrowed from you. They on-lend that money to a borrower at a higher rate because they have to make their money somewhere, right? And then what they do is, if it's a company, I should say, they will use that money to expand or to produce product that allows them to generate a higher income or a higher yield than they are paying you, the lender. So if your money is sitting in a cash account, you can withdraw it at any time from the bank, right? Which leaves the bank in a bit of a predicament, because let's say they have taken your money, which you left in the bank, and on-loaned that money to someone for, let's say, a 20-year home loan. And they'll get that money, the 20-year home loan, the mortgage, they'll get that money back in bits and pieces over the 20-year period. So of course, if you and the other people with cash promise to leave your money in the bank for 20 years, then it's less of a risk to the bank. Because if you withdraw your money before the 20-year period, the bank basically has to replace you and get that money that they've loaned to someone somewhere else. So effectively, fixed deposits should offer higher interest rates than the overnight bank deposit rate. Also, the bank is paying you for the risk you're taking that it will still be around in 20 years' time and that you will get that full capital as well as all the interest payments at the end of it. And that theory is exactly the same as investing in bonds. The nice thing about bonds is that all of this is agreed up front. So you're going to be invested for 5 years at, let's say, 10% per annum, assuming you're going to get interest payments every 6 months, which you can then reinvest. You can calculate exactly what your return is at the beginning of your investment, right? So you know, if you're buying a bond, you're lending someone money, they will pay you interest and every 6 months and repay your capital at the end of the period. You take that interest, reinvest it, and now you can calculate exactly what your interest is or what your investment is going to yield. And this is how you do it. So very quickly, memorize that formula, and then we'll work through an example a bit later, okay? Oh, no, I'm just kidding. No, I'm just kidding. But this is exactly the problem. This is why bond investing gets a bad name. They're just not as sexy as the risky high-jinks equities investments that we know and love so well. Like it's so much more fun to think about something like a Woolworths and decide whether or not consumers in a difficult economic environment are going to shop at Woolworths, or are they going to shop at Pick n Pay, or are they going to shop at ShopRite? And whether or not the billions of rands, which you probably loaned to Woolworths through you buying bonds, whether or not they'll invest that in Australia, and whether or not that's going to pay off the way it has in South Africa. And the other thing is, are people going to buy food at Woolworths, and maybe they'll buy their clothing at Mr. Price? So you see, if you're an equity investor, it's kind of like, it is actually just a little bit more exciting. Oh, what about that guy that replaced Ian Moyer as the CEO? Like, is he any good? You know, so you can go to the Woolworths results presentations, you can go to the AGM, you can vote, you can make do your analysis, you can decide whether or not the shops are full, whether or not you yourself are going to shop at Woolworths. But just look at that formula. I mean, that is just, you know, that's the problem. So just figuring out the yield and returns for your bonds, it is more certain, I should say. It does require a bit of mathematical commitment, which we all know makes most people very nervous. And I don't need you to understand the equations, but what I do need is just to very quickly revisit the efficient frontier. Now, forgive me for this. I'm literally taking this definition straight out of Investopedia. The efficient frontier, what you're looking at now, is the set of optimal portfolios that offer the highest expected return for a defined level of risk, or the lowest risk for a given level of expected return. So portfolios that lie below the efficient frontier are suboptimal because they do not provide enough return for the level of risk. Portfolios that cluster to the right of the efficient frontier are suboptimal because they have too much risk and not enough return. So in short, there is little risk in keeping your money under the mattress. So you can see below my dotted red line, except of course that inflation will eat into the value of your cash, but you will still retain the face value of those notes, but you're just not going to make a return on that money. And once inflation has had a go at it, it's actually worth less than when you put the cash under your mattress. Just above that, you've got a little bit more risk. So now what we're doing is we're climbing up that risk curve and expecting a higher return. And even if you put your money in the bank, it's not really, mostly, I should say, of course, we're going to forget about kind of the BlackRocks and the African banks for a minute. It's not much more risk than putting your money under the mattress, and yet you're getting a higher return. And then you'll see, today we're specifically looking at the bottom half of the efficient frontier, the ones I've ringed, the money market, term deposits, government bonds, investment grade, corporate bonds, which in theory should be less risky than your real estate, blue chips, small caps, and private equity, but with a higher return than the cash in the bank or cash under your mattress. So I keep talking about this risk, right? So we're in this very risk-averse environment. So let's just quickly clarify exactly what that is. Basically, risk is measured by taking the square root of the variance. I'm just kidding. No, seriously. Okay, I'm going to get serious for a minute. These equations are dreadful, aren't they? This is real risk. For each of us, risk is the need to withdraw your investments when the market has plummeted. So this is a graph of the JSE for the last 20 years. Imagine you had invested at the blue arrows, then something came up, well, because Murphy's Law, and you need to withdraw your investment at the red arrows. You would lose 30% of your capital. And that is, it's very risky strategy, because imagine you were investing to save for, I don't know, your child's education or a deposit on a home. And suddenly you're having to withdraw the money now and it's worth 30% less. That's big risk, you see. And look at that, and let me just remind you very quickly, that is a graph of the equity markets. I'm moving now away from bonds just for a second, but I do need to move back to bonds quickly, because that's what we're talking about today. And what you're looking at when you're buying a bond. So basically bond analysis. And the four main things: you need the credit worthiness of the borrower. So let's, for example, can't think of a very good example at the moment, but you can imagine two people, you lend both people money. One will definitely pay you and the other one maybe not repay you. And that's all we're trying to measure here, right? The credit worthiness of the borrower. If you're going to lend person A 100 Rand and person B 100 Rand, surely you want the person B to pay you a higher interest rate just in case they don't have that 100 Rand at the end of the 5-year period we were talking about, right? And that's your yield. So your yield versus risk, your risk on person A versus your risk on person B. And then time to maturity is another risk or another analysis that should be taken into consideration, because actually, if you think that if you lend me money, for example, and you know me fairly well, you know that I've got cash flow, and that actually at the end of the month, I probably will be able to repay you the 100 Rand you loaned me. But are you sure that next year I'm still going to have my job and be able to repay you, or that in 5 years' time I haven't forgotten, or that I've lost my job, or I've moved countries or done something where I can't repay you? Also, if you're going to lend me your money, the one thing I spoke about having money under your mattress is that in 5 years' time, because of inflation, that money is going to be worth less. So actually, you need me to pay you a decent interest rate on the money you've loaned me. And I know that that the problem with these with bond investments, and well done everybody for joining, is that it's a little bit boring, actually, to be honest, but don't worry. So if I'm going to stick with this 007 theme, we have something called credit rating agencies. They're kind of the Miss Moneypenny of the bond market. I've done myself a huge disfavor by doing this James Bond 007 analogy, because I can't actually say the word bond without thinking 007 at the moment. But you've got basically the Moody's, Fitch, and Standard & Poor's. And I'm sure you've all read about how we've been downgraded by all of these, so that the South African government, the sovereign debt, is now actually in junk status. And this is what it looks like. So why they can't use the same system is beyond me, actually. But they each have their own scale. And then on the right, you'll see it goes from high grade, upper medium grade, lower medium grade, and then into junk. So non-investment grade, they call it, or speculative. Basically what South Africa is at the moment. And there's all a variation on each of these, triple B plus, triple B minus. And it's just, it's not as difficult as they really want to make it out to seem. But the one thing about bonds is that we actually have benchmarks, and generally speaking, and I'm not sure I can think off the top of my head of an example, I should have looked this up, sorry. But generally speaking, a company in a country cannot have a higher investment grade than government. So if government is junk in South Africa at the moment, that means that pretty much every company, every state-owned enterprise, bank, everything, who issue bonds should be considered junk status, or I should stop saying that. Let me say non-investment grade. And the problem for us is that because we are non-investment grade and we are a riskier investment than, let's say, the US government, we actually have to pay a higher interest rate. It's the story of person A and person B. So if you lend me money and you're not sure if you're going to get your 100 Rand at the end of it, then you're going to charge me a higher interest rate just to make up for that risk you're taking. Have a look at this, just because we were talking about government debt. This is what the South African government debt looks like, and I could only find numbers going back to 2003. So you can see over the period how it has accumulated. Nice little drop in 2016, then a continued spike. And this is actually in USD millions nominal, right? So this is actually in a number, call it. But it really makes no sense, because what you really want to look at, and what is just more accurate, is that you need to do a comparison. Like, it's one thing to have debt, but quite another to be able to afford to repay it. And the only way you know if somebody is able to repay the debt is to measure it against how much income. So person A and person B again, you may lend me 100 Rand, but the 100 Rand to me may be, let's say, I don't know, 50% of my income, in which case I probably will struggle to repay it. And person B, it may be 1% of their income. And so obviously they'll repay the 100 Rand to you much easier than I would, for example. And this is the graph you're looking at now. That heading is incorrect, my apologies. It should say South African government debt as a percentage of GDP. So you can see, so almost the other graph was almost, the previous graph was almost irrelevant. So in 2000, our debt to GDP, government debt to GDP was 43%, all the way down to 28% in 2008, and currently sitting over 60%. Now, how does this happen? Well, for so many things, but today's example is probably SAA. Again, this morning I heard on the news that government is saying it needs, I think it was 26 billion Rand to just make sure that SAA goes into business rescue, that a new company is formed, that they are able to pay the retrenchment packages that they have to offer to downscale the company, and then to keep it going again. And that's how it happens, you know, not to mention the COVID-19 crisis, where government, because government doesn't have 500 billion lying around that they can use for aid relief as people lose their jobs during the COVID crisis, they're having to borrow that. So as you can see, since 2008, South African government debt to GDP basically, call it income if you like, has just steadily grown. Okay, that's like, sure, that's the problem with the bonds, right? There's just so much theory. It's just not nearly as exciting as all the companies I often talk about. But what I have done for you, and this is the last thing I'm going to show kind of, is just had a look at a few funds, right? So you can either go off and put your money in the bank, which you as an individual can do. So that's on the right, your bank deposits, or you can actually use your retail bonds. And what I've done here, you can see those two, the risks are fairly low, and you can see what the annualized return looks like. Then you've got the short dated, the 3-month exchange traded funds, which you can find on the Easy Equities platform. Fairly conservative again, investment, look at the return. So all bonds generally, I must say generally here, fall into kind of this moderate to low investment, if you like. And then the new funds, government bond exchange traded fund, you can see what the returns look like there. So there's a bit of homework for you to do, unfortunately. Of course, there are those. And then you can also be invested, I have to plug my own business, right? The Cartesian Money Market Unit Trust, which you can go, just Google it, you'll find the fact sheet anywhere. But again, the aim of this fund is capital preservation. So we're trying not to lose your money for you and still giving you a yield that is better than the bank return. Okay, so in short, bonds tend to be less volatile and less risky than stocks, and when held to maturity can offer a more stable and consistent return than the equity market, for example. Interest rates on bonds are often higher than savings rates, which I've made a point over and over about. So don't leave your cash in the bank, choose a money market or a fixed deposit or a bond fund to be invested in. And then bonds tend to perform in the opposite direction to share portfolios, right? So when stocks are falling, interest rates fall and bond prices rise in turn. So it's slightly less exciting than stocks, but bonds are a very good diversification tool to have in your portfolio. And that's my presentation, Carl. So if you have any questions.
I've got lots of questions as to our listeners. So thanks very much, Anthea. I was also been chatting while you're doing your presentation with a couple of the listeners. And one of the themes is an appreciation for your ability to not dumb things down, but make it understandable. And one thing that I've learned in the investment market is that the emperor has no clothes is very true. And so it's great to be able to ask these questions and to learn, because ultimately we're all interlinked. I mean, just your example of the bank uses our money. So, you know, they're dependent on us. And I don't think people realize that the bank has that ability to take our money and lend it out and make money for themselves. So, but let me start off with a couple of questions. You mentioned at the end, you gave some examples of where we could access bonds. Where would you access the RSA retail bond? Where could you buy that? I mean, is it readily available?
Yeah, it's not that easy for the retail investor. So you probably would have to go onto a platform. There's a couple of platforms that offer it. Otherwise, your financial advisor, you probably need to go directly to. And also because it does come in fairly chunky allocations, if you like. You know, it's not a bond that you can go and buy for 100 Rand. You need a decent portion of cash to do it. So yeah, it's not that easy, I'm afraid. Just Carol, on the banking system, I think I must point out that this is what happened in 2008, 2009. It was called the global financial crisis because, you know, the financial system is actually built on trust, believe it or not. Like, so we all go and put our money in the bank, they unlend it. But when there's a run on the bank, like there was on BlackRock in the UK at the time, when the consumer, it's like voting, right? When we go and withdraw all our money, the bank actually collapses. And it's quite a scary thought to have. And I think the Reserve Bank in South Africa has done a fantastic job, really, of managing the banks, managing their liquidity requirements, ensuring that they are financially stable so that if you and I tomorrow go and withdraw our money, surprise, the bank actually has enough cash, generally speaking. And that's the Reserve Bank's mandate, if you like, or one of their mandates, I should say. But yeah, it's an interesting interlinked system we have.
Yeah, I think it's a good point, Anthea. The users can also follow the Reserve Bank and governors and related parties on social media because they're really good at posting information and they do a phenomenal job. I mean, when you mention our debt as a percentage of our, simplistically, the country's income, and it's sitting in the high 60s, I suspect that everybody, you know, rolls our eyes and bloody government and all the rest of it. But I'm often struck, you know, I ask my friends, how many of you has a debt ratio of only in the 60s? Most people I know manage their money far, far worse and live purely on credit. So it's not that easy to keep that low. And I think we should perhaps be a little bit less judgmental and all look to ourselves and what we can do to contribute to that. It's not just the government's role.
But I think that's such a good point. You know, we always kind of look because, oh, government spending and government's borrowing, but GDP is actually production. It stands for gross domestic production, right? Or product, I should say. So what are you manufacturing? What are you creating? How much are you generating to help the country grow is such a good question.
Absolutely. So I want to talk a little bit about risk, which is an element that you spoke about. And I want to suggest to you that not taking risk is perhaps risky. And maybe to chat to us a little bit about what kind of risk appetite a user should have to invest in these bonds. I mean, I know you said conservative and all of that, but just to explore the concept a little bit more about risk, you know, is it valid for a student and a retiree to both be buying bonds?
Yeah, good question. So I don't know how many hundreds of people on this webinar, but I can't tell you what risk you should take. You know that, right? And I think everybody should have a couple of portfolios, so diversified and not just one portfolio, but let's have an emergency fund. So don't go and use your emergency fund, which you might need in 3 months' time or in a year's time, and put it in the equity market. For that, you need to be in less risky, or, do you know, Carol, let's say less volatile. How's that? Let's say less volatile investments so that when you need your money, you've still got the full amount of capital and hopefully some growth on top of that. But if you're young and you're saving for your pension fund, no, then absolutely you should be practically 100%, oh, I shouldn't say that, almost, you know, as fully allocated into equities as regulation allows in your pension fund. And there are regulations. Regulation 28 governs how we as asset managers can invest funds for pension funds. You know, we're allowed up to 75% in equities. We're allowed, I don't know what the number is, 5%, I think, in private equity. We're allowed, I think it is now 12% offshore. But the point is that if you're young, yes, you absolutely should be taking risk. And especially if you're, it's long-term, it's discretionary. On average, the JSE has returned between 14 and 16%. I'm not sure exactly what that number is today because we've had such a great bounce in the market since March. But that's a lot higher than the 3% that you're getting in cash in the bank, which is the low end of the risk or volatility spectrum, right? And maybe it doesn't sound that much, but compounding that makes for a huge difference. I mean, I always talk about compounding interest. And if you want to know kind of how that works, here's one that I've every once in a while kind of brought to everyone's attention. To know how long it's going to take you to double your money, you use the rule of 72. So if you're getting, let me think for an easy one. Let's say you're getting 3% in the bank on your cash. It's going to take you 20 years to double your money. But if you're getting, let's say 14%, Carl, do that number quickly, 72 divided by 14, right? It's below 5, isn't it? Less than or around 5 years to double your money. And that's what compound interest does. And that's the difference between leaving your money in the bank and investing it in a stock market that gives you a higher return. So diversification and understanding your term of investment is key.
Thank you very much. That makes a lot of sense, Anthea. And I think just tying in with some of your thoughts there, we must remind everybody who's listening as well that investing is not gambling. It's not a casino. You can go and trade if that's it. And I think it's an important point because now when the markets do well and people read about a Sasol share price, for instance, and the tremendous amounts of money that people have made, another maxim that you and many others always point out is also don't try and time the market. Because you could really end up losing your money. So investment is consistent. It's putting away as much as you can, regularly, as often as you can. But it's not gambling. It's not a casino. I mean, I think it's a vital point that we've got to emphasize.
But Carl, isn't this why we're doing these webinars, right? So that we can educate our investors and make them understand things like time in the market, which are your riskier, your less risky assets, where you need to be invested and why. You know, so of course we can also talk about individual stocks, but that takes some work. You know, as you say, Sasol is a great example. Like, do we know when they're going to do a rights issue, or do we know what's going to happen to the oil price? And if the oil price drops to below 20 again, does that mean that they breach covenant? So there's a bit of work to be done. I tell you what, it's addictive though. It's a bit as addictive as gambling. It's not gambling.
But Anthea, that's a great point. I mean, I love a lot of the investors that we've got on these webinars because they are so passionate. So using that Sasol example, pick up a newspaper, read about what they're doing in Lake Charles in America. Just about everything can be brought back to shares and investing. And you, I must say, one criticism I have of you, you actually do a really poor job at plugging your own business in yourself. So I'm going to do that because I think part of what users have also got to understand, even if you use an asset manager, even if you use a financial advisor, it doesn't mean that you don't get involved. Question them, ask them about it, and you're open to that. I mean, you love discussing, as part of this webinar, with users. So, you know, for instance, take your money market, your unit trust that you showed us. I mean, what is the return on that offhand, putting you on the spot? So
the annualized return is 6.86% on the spot. More or less.
That is
so yes, so significantly higher than bank returns. I will tell you that it is linked to the interest rates in the country. So as interest rates come down, that interest rate comes down a little bit, but again, much higher, almost double bank interest rates at the moment.
Exactly. And my point though is you're happy and keen for users to challenge. How do you decide what goes into portfolios you select? You know, why do you change? How often do you do? I mean, you don't just pick a portfolio and leave it for a month, a year. I mean, you are a little bit fanatical, like many others on this webinar, in really, being focused on this.
So one of the things we've done recently is started running managed accounts on the Easy Equities platform. And I am having probably the most fun engaging with people who run these managed portfolios, because they want to know, we've chosen shares, we talk to them obviously, and we say, this is what you want to do, this is who you are, and this is what we think your portfolio should look like. So if it's going to be 50% money market and 50% shares, these are the shares that we want to choose. And let me tell you why I'm choosing these shares for you. So yeah, there are a couple of speculative trades, like our MTNs, for example. It's a very volatile share. And there's always something with MTN. If it's not the oil price, it's Nigerian tax. There's always something, or lower subscriber bases. Or let's say you're closer to pension, but you still want to be invested in shares, then maybe multi-choice, because they pay a great dividend. And I must say, I'm really having more fun with those managed accounts and engaging with my clients than I think I've ever had in my entire investment life.
Well, I think it's the win-win for users, because they don't really have to have the worry, but they can remain engaged and interested. So you do all the hard lifting and we get the benefit and the fun out of it. And there's something that a couple of us don't understand that I want to talk to you about, linked to the bonds, which again is obviously mainly what we're talking about today. So as I understand it from you, you've got to have some faith in the government paying back the money that we're lending them when we buy the bond. So the news that's been around for a while about South Africa accessing an IMF loan, is that a good thing or a bad thing? How would that affect holders of a bond? And do you think that's going to happen?
Do I think it's going to happen? I actually do think it's going to happen, but I think it's a way away. So if you'd asked me before the Corona crisis, do I think it's going to happen? Actually, I didn't think so. I thought that we could trade our way out of this and start, being a productive country where our GDP, where we reignited the economy and our GDP growth was would turn around this increasing trajectory of our debt percentage to our revenue. Now with the Corona crisis, the number that's being bandied about is that once you reach 80 as an emerging market, once you reach 80% of debt to GDP, that's when you go to the IMF. And I think we're quickly climbing to that, probably going to reach it in the next year to 18 months. Now I'm guessing because I don't know, right? But those are my projections. So in my head, that's the number. And so is it a good thing? That's like saying debt counseling. Is debt counseling a good thing? When you get into the position where you need debt counseling, it's a terrible position to be in. It's terrible. But the debt counseling itself is actually a good thing. And what happens when we go to the IMF, they'll say, sure, we'll bail you out, but we're taking over that little check writing book of yours, right? We're going to manage your expenses for you and make sure that you reignite your economy and that you're able to repay the debt that we're now giving you money, because you're probably going to use that to repay some of the debt that you already have on your books. So basically, we're going to run your expenses account for you. So debt counseling is a good thing, but getting there is not great.
Yeah. Thanks, Anthea. A couple of questions from our users. One from Ramonde, which I think you've partly answered, but is there a ratio that you would advise in terms of bonds in a local portfolio? Bonds, cash, stocks, excluding the emergency fund we would have.
So I'm going to refer to Regulation 28, actually, which is the pension fund regulation, because those very clever people have thought about it quite carefully. And I think what they'd like to see, if you're young, anything between 15 or maybe 10 and 25% bonds. And if you're older, then you need 7 or closer to retirement, you should say. And I'm talking kind of in your 60s already, like late 50s, 60s, then you probably want 75 to 80% in bonds. And Carl, this is a great question for not just, giving you a simplistic answer of ratios, but actually what's happened in recent years, which I've read a lot about and is worrying, is that so many people in South Africa don't have enough in their retirement savings to retire comfortably. And so unfortunately, even though I say you should have 75 or 80% of, low risk bonds or kind of income generating or yielding assets in your portfolio as you get close to retirement, unfortunately, because of so many of us in South Africa don't have enough money, we're actually having, or we're being forced to, or we should. I'm actually, I'm going to be brave and I'll say, we should think about upping our exposure to equities so that we do make a higher return and we do have more money to retire with.
So Anthea, I agree with you. And I think that bravery is something we've all got to face. It comes back to the concept of not taking enough risk is in fact risky. So when you are younger and you're not investing in equities, which are more risky, they're not risky, but they're more risky than some of the other instruments, it's not a smart move. So I think more people need to be brave in the financial services and advice area and asset management space, because how many people do we know that can retire? I mean, basically nobody. I'm a privileged white South African, and my father's 82 and working. Now that's from privilege, so retirement is not something that I think is easy for people, and we've got to take it far more seriously and be more honest in our conversations. So here's another question for you from our millennial gentleman. Bonds pay interest regularly, so can they help generate a steady, predictable stream of income?
Oh, the answer is absolutely yes. It's, that fabulous equation I showed you earlier on about kind of where and how to calculate what your yield or your return on your investment is going to be. So in the equity market, because you've got this volatility, the Sasol share price, is it going to jump to 250 or is it going to fall back to 30? Like, you don't know. But when you buy a bond, and government bonds, the R186, which I think matures in 6 years' time, if I'm not wrong, is currently yielding 7.3% last time I checked. So you know exactly how much money you're putting in and how much you're going to get paid every 6 months, because these bonds only pay twice a year. I mean, it's calculated monthly or daily, actually, or whatever you've invested, the interest is calculated, but you only get paid out every 6 months. So yeah, you can definitely use it as a nice, secure way of generating income.
Anthea, two linked questions. Can foreigners buy our bonds, South African bonds? And linked to that, and you alluded to this partly with your example of the ETFs that are bond linked. Can South Africans have exposure to overseas bonds, so non-South African?
So the first question, can foreigners buy South African bonds? Absolutely. And in fact, it's one of the problems with the bond market. It's why the bond market is so volatile. It's because we have foreigners buying and selling our bonds every minute of every trading day, quite frankly. And in fact, they're currently loving South African bonds because our yields are so high. So you try and invest your money or buy bonds in the US or in Switzerland or in Japan, where you have negative yields. And so in case you're paying the government to hold your money, which is the most bizarre concept, right? Here, if you give our government money, they'll pay you. They'll pay you kind of almost 9% on the longer term bonds. So foreigners look at us and think, are we as South African government going to default on our debt? Because if we're not, then they're going to take that 9% and run with it, So yeah, foreigners definitely buy South Africa. They love South African bonds, in fact. I know there's a lot of talk and a lot of negativity about debt to GDP and the way South African government spends, but we're fairly good at repaying our loans, actually. We're believe it or not. It's the one thing we do very well. And then the other question was, can we buy foreign bonds? Oh, absolutely. And you can't buy them directly, but you can buy them through funds and ETFs. Yeah. And I'm pretty sure Easy Equities would have a couple on their platform.
Yeah, through a couple of the ETF providers, yeah.
Yeah, sure.
So I think it would be useful for people to do research on that. And on your point about default, because there've been a couple of questions on that, will I get repaid? It is based on trust. It's like any money that you lend. So it's important to do that research and look at track record. It's fascinating.
And Carl, use the ratings agencies, because even though South Africa is, in inverted commas, junk status, it doesn't mean that we're not going to repay. Our risk of default is relatively low, actually. And that's why, you know, we're in junk status and we pay high interest rates compared to the rest of the world, but it doesn't mean default.
Yeah.
There've been very few defaults, government debt defaults, actually, in the last couple of decades. You know, there was Asia and there was Argentina and Russia. I don't think South Africa falls into that category yet.
And not to minimize the real challenges that we face in our country, partly because of our history, you know, it bears repeating what you've said before, that foreign investors with cash look to South African government bonds because of the excellent return. They don't go to Switzerland, they come to South Africa. And we need to, you know, understand that. And there are a couple of anonymous questions, and I'm sad because they're not difficult questions. I was hoping if they're anonymous, because I'm trying to find questions that you're unable to answer. But these are easy and nice ones. So the one I'm going to answer, because it says, is there a recommendation of what percentage you should be investing monthly of your salary? And for me, the short answer is as much as you possibly can, and then some. So, you know, the more you can, and even if it is a little bit, if you can invest an extra 50 Rand, do so. If you're able to invest an extra 5,000 Rand, whatever your quantity, do so. I mean, I'm sure you'd agree with that. Invest as much as you possibly can.
100% agree with you. You know, there's a lot of numbers that get bandied about by financial advisors that you have to invest at least between 20 and 30% of your salary. I don't know. Like, I'm with you, as much as you possibly can. You know, this is long-term thinking, kind of create some wealth for yourself.
Absolutely. And then we've partly answered this question in terms of investing directly in a bond and investing via platform. I mean, your answer is that you can't always, often you can't invest directly. You do have to do it via a platform or an advisor, etc.
Yeah. What's the question?
No, so I'm just saying we've answered that, and I'm just wanting to, because we don't put me on the spot like that. I wanted to, I've had some questions emailed, and I just want to make sure that we've addressed all of them, Anthea. Yeah, so here is an interesting one. If bonds are these yielding instruments that you're alluding to, why does the value of the bond fund change frequently, daily?
Yeah, so this is a great question, because what I've explained to you really is yield to maturity. Buy a bond, and if you're buying a bond at 7%, you know, you can calculate that every year the bank or government is going to pay you 7% in interest, and so until maturity, when they pay you the full amount. But because the bond market is dynamic and changes every day, and so actually bonds can change hands, so you don't have to buy a bond at what we call the auction date, because that's how bonds are priced, or that's how they're issued or released. You know, it's not like a share where you have a big IPO. These happen in auctions or issuing. So you don't buy it. You can buy it at the start when the company or the government issues the bond, or you can go into what we call the secondary market and buy it from somebody who bought it right at the beginning, pretty much like the share market, right? So there's an IPO, you go in, you trade, and every day somebody's buying and selling shares. Same story with bonds. Every day somebody's buying and selling bonds. But because so many things change on a daily, weekly, monthly, yearly basis, like the Rand exchange rate, interest rates that the bank releases, like the repo rate, for example, inflation, credit worthiness. So our credit worthiness versus another country's credit worthiness, you know, it changes very regularly. And so the bonds get repriced. And that's that horrible equation I showed you with our bond girl earlier on. It's you can recalculate or reprice it. When you buy the bond, you buy it at what we call par value. And then as you move forward, that you can buy it at more than par value, at premium, or below par value, depending on what the value in your head is for this bond, or your calculation is for the bond. So in other words, if I was a US investor and Brazil was offering me 8% and South Africa was offering me 9%, different maturities, different credit worthiness. Today, maybe I decide, actually, I like South Africa more than I do Brazil, so I'm going to go and buy it. But I didn't buy it at 7%, you know, at issuance, or I didn't buy it like at the beginning of the year, so I'm definitely going to get my 7% at the end of the year. And so those calculations happen and take place, and that's why bond prices change and bond funds change.
Yeah. Garth has made a good point. Just to clarify, when we talk about compounding interest, then it's not relevant to buying bonds, because you're not going to be able to reinvest your interest payments. So the compound interest was more a point around general investments and just starting as soon as you can, being consistent. Yeah.
Well, no, I don't know if I agree with him, because if you if you reinvest your interest that you're receiving, then you're compounding it. If you're taking it out and spending it or investing it in something else, then you may get a higher or lower return depending on what you're investing in, or a zero return on your interest if you're spending it. But if you're reinvesting it, no, it's definitely called compounding. That's the best way to go.
What are investment grade corporate bonds? Question from Joanna.
In South Africa, well, as I was saying earlier on, I can't think off the top of my head a company that has a higher investment grade than the country it is operating in. Like, it's just one of those things in the investment market, when you rate it. I seem to think that one of our banks very briefly at one stage had a higher rating than our government. And I think it was First Rand, but I'm not sure about that either. So currently we're all non-investment grade, quite frankly, but offshore, certainly, you can easily go and find investment grade bonds. Don't be scared of non-investment grade bonds. They're called junk status, which is terrible, but they're also called high yielding bonds. So there are actual funds that run and go and look for high yield instruments like South Africa to be invested in.
I think that's an important point, and it gets back to your risk appetite. So don't be scared of exploring that. It might well be suited to you because you might well get a higher return.
Indeed.
Anthea,
I think, Carol, can I just, one thing that while we're talking about these government bonds is the recent issue we've had with Land Bank. So government in South Africa basically guarantees most of the state-owned enterprises' debt. And that's how also one of the reasons we get into this high debt to GDP ratio, because government takes on, in inverted commas, almost the debt of state-owned enterprises or the companies or their subsidiaries, if you want to look at it like that. And so Land Bank was quite an anomaly, because recently they said that they were not going to pay back the bonds that they had issued. And there were maturities for this year, next year, and the year after, 2021, 22. They didn't pay back in June the interest that was due to investors. So they basically defaulted, which is terrible, because if the government guarantees it, the government should actually step up and repay it. So we've had a couple of anomalies in South Africa, and we have a huge anomaly in South Africa at the moment, in fact. But yeah, so you do have to look out for these potential defaults, but generally you're fairly safe.
So we're going to end off, and I want to try and bring a couple of the questions together and relate to some of the points that you've made. So today we're largely talking about bonds. We're largely exploring in an environment where interest rates are low. Where should we be investing? So if I'm understanding you correctly, you still maintain the position, diversify. So don't put all your eggs in the proverbial one basket. So spread it across different instruments, different providers, different maturity stages. I think diversification is a big point that we should look at or remember from what you've said. Secondly, that it's not one size fits all. So it depends on your age, your circumstances, what you want to need cash for. So some users are asking us, what percentage would you recommend? And that's basically impossible unless you're having a one-on-one with somebody. And so I think we could also encourage people who don't want to do it themselves through an Easy Equities platform and looking at some of your funds to engage with a financial advisor and question their financial advisor about Cartesian products, RMB products, whatever product they want to explore. But the point is to link it to your own personal situation rather than thinking that there's a perfect answer from somebody like you. So with that long introduction, I do want to put you on the spot. If you had to pick 2 bonds for us, would it be the ones that you had earlier, or what should we go and explore?
Yeah, I would, again, very difficult to say what your risk appetite is, But I was talking about anomalies earlier on, actually, and one of the anomalies is that the consumer is almost theoretically more creditworthy than government at the moment, because as a consumer, I can go to the bank and borrow money at a lower rate. I can borrow for my mortgage at a lower rate than the South African government can borrow in the market at the moment. But I like that, because as an investor, I can actually invest in government bonds through these ETFs or funds on the platform and get a nicer return, basically, than I'm getting in a bank. So I do like government bonds at the moment, because they're fairly safe-ish, but the returns are so high. It's wonderful.
Cool.
Relatively speaking.
Tabo's got an interesting question around the currency. So our currency being stronger or weaker against a dollar or others, the fluctuating rand, how does that play into bonds?
So the rand's always a difficult one because it is so complicated. But I think probably the most important thing with the rand is that as the South African government borrows in US dollars, this is a problem. As the rand weakens, their ability to repay the US dollar denominated or euro denominated bonds becomes more difficult. So it just becomes more expensive. So you imagine that every year they have to pay $100. As the rand weakens from kind of 7 to 15, call it, that rand amount that they're repaying is quite significant. So that definitely impacts South African government or South Africa's credit rating, if you like, and therefore will impact on the value or the price of the bond in the overall bond trading market.
Cool. So as we conclude, Anthea, I want to say a big thank you to you for taking the time to talk to all kinds of investors and to really underline the point that retail investors need to understand that they've got lots of power to educate themselves, to listen to these webinars, to ask questions. Again, since you're bad at it, I'll do it. Google your name, listen out for you, read what you write. Read magazines, newspapers, listen to podcasts, talk to your friends. You know far more than you think you know. And then with all of that information, make a decision for yourself. But investing is very exciting. It is not something to be scared of. It's not something to outsource. We must use the professionals like you. Also, people are interested. Anthea is talking in a couple of days, I think the 20th or so, at a TEDx event. So you can Google that as well. As I've said before, Anthea is not just a clever asset manager by day, but she has a few other tricks up her sleeve. So TEDx events are always interesting. I think you have to register, but it is a free event, or do you need to pay for it, Anthea? I can't remember.
No, that's correct. There's no cost, but they do recommend registration. So I'll be speaking on this Saturday at 2:00. And there is, I don't think, anything about investments in it. So it's all about my life. It's all about me. And the topic is bravery is the only choice, lessons in embracing the unknown, which quite frankly, in this environment is almost perfect, right?
So Anthea, I think I disagree with you, because your life story, I would suggest, has a big impact on what you do and how you do it. Just like other retail investors, no matter how you grew up and what challenges you had or didn't have, it influences how you invest. And I think it's great to learn about other people's stories to help you invest. So please don't gamble. Investing is not a casino. Don't chase the money. Don't try and time the markets. Give lots of thought before you invest. We'll send the link out to everybody. Anthea, you're going to be doing another webinar next week. And do you want to share the topic and your guest speaker?
This time, next week, we're talking about the rand, because this is, sometimes investing can become so emotive, and the rand is particularly an emotional subject. And people, I think, South Africans are very navel-gazing, in my opinion. We think everything is about us. So what I wanted to do is look at the rand, the impact of the rand, how the rand moves. Is it about us? Like, you know, everything that we do in South Africa, is that what moves the rand, or the exogenous external factors? So we're looking at that, how that's impacted the stock market. And then I've brought in an old school friend of mine, Judith February, who is a political analyst. And because, you know, because we've had things like our weekend special finance minister when we did see the rand blow out, and that really was all about us. I want to understand from Judith kind of where we are politically. And I know poor old Cyril's been through kind of, wasn't he great at the beginning of coronavirus, and now he's just kind of lost all that excitement and that support from us. And how does that play out into our investments? So that's our next talk next week this time.
Yeah, and I think it will be very useful. I'm looking forward to it, because to get some unemotive, practical, factual information from the two of you in an area where we are all so emotional, I think would be really useful in guiding our investment strategies. So thanks, Anthea. Have a good rest of the week. Thanks, everybody, for tuning in, and good luck with your investing. Make some money. Cheers.